Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and welcome to a new business week. This is Peter Lewis with an update on this morning's business, finance and economic stories right here on Money Talk on Monday the 22nd of July. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, President Joe Biden has withdrawn from the US presidential race after weeks of mounting pressure from Democrats. He says it's in the best interests of my country and the party, but he will stay on for the final 6 months of his term. Mr. Biden endorsed Kamala Harris, his vice president, to be the new Democratic nominee. Ms. Harris says she intends to earn and win the nomination and do everything in my power to unite our nation to defeat Donald Trump. Businesses and services around the world are slowly recovering after a massive IT outage affected computer systems for hours on Friday. Banks, hospitals and airlines were among the worst hit after cybersecurity firm CrowdStrike issued a faulty software update which affected Microsoft Windows. It was described by some experts on social media as the largest IT outage in history. Beijing needs to implement more proactive stimulus measures to distribute growth more evenly among regions and industries. That's according to a senior Communist Party official, as the world's second largest economy struggles to recover from a prolonged property slowdown. Hang Wang-Zhu, deputy director in charge of the party's financial and economic affairs, said on Friday at a media briefing on the third plenum, we need to introduce and implement more robust and effective macroeconomic policies. Proactive fiscal policy must be used to better effect, he said. Data released Friday shows that Japan's core inflation rate rose to 2.6% from 2.5%, accelerating for the second month to a 3-month peak. Japan's core inflation reading was lower than the 2.7% expected by a Reuters poll of economists. The latest core reading reinforced market expectations that the Bank of Japan could raise interest rates from current near-zero levels when it meets on July the 30th and 31st. On today's Money Talk, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul. And providing a view from mainland China will be Yanan Wu, the Chairman and CEO of Surfin Group. If you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks retreated Friday as Wall Street wrapped up the week defined by a rotation out of this year's mega-cap tech winners in favour of names viewed as bigger beneficiaries of interest rate cuts from the Federal Reserve, like small caps. The S&P 500 dropped 0.7%, closing at 5,505. The Nasdaq Composite slid 0.8% to end at 17,727. The Dow fell 377 points, that's 0.9%, to 40,288. The small cap Russell 2000 was down 0.6%. Over the 5 sessions, the S&P 500 slipped 2% and the Nasdaq tumbled 3.6%, marking their biggest weekly losses since April. And the tech-heavy Nasdaq also snapped a 6-week winning streak. On the other hand, the Dow advanced 0.7%, while the Russell 2000 climbed 1.7% over the week. US Treasury notes saw further selling pressure on Friday. Yields ended up around 5 basis points higher across the curve. The 10-year yield rose to 4.25%, matching the previous Monday's peak, and the 2-year yield is at 4.52%. The US dollar index jumped back to the highs of the week Friday, rising 0.33% over the 5 sessions. The Japanese yen hovered around the 157.5 yen per dollar. The offshore yuan depreciated past 7.28 renminbi per dollar as traders assessed the outcome of the third plenum. Spot gold continued its retreat from record levels as the precious metal ended the week 0.5% lower at $2,400 an ounce. Brent crude oil ended the day and the week in the red, dropping 2.9% Friday to $82.63 a barrel. That's the lowest in a month. Bitcoin posted a weekly gain of almost 15% in its best week since March to end at $66,700. Hong Kong stocks tumbled on Friday after China's third plenum announcement underwhelmed. The MSCI China index slumped as much as 1.7% on Friday, falling every day last week. The Hang Seng index fell 361 points, or 2%, to 17,418, bringing the week's losses to 4.8%. On the mainland, the Shanghai Composite Index added 0.2% to 2,982 as the so-called national team stepped up purchases of exchange-traded funds tied to shares on the mainland. Futures markets pointing to a flat open for the Hang Seng this morning, projected to start the day trading at around 17,420. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's kick off the week and welcome our Monday morning guests. We have with us Alex Wong, Director of Alex KY Wong Asset Management. Morning to you, Alex.
Hi, morning, Peter.
And also with us is Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul. Good morning to you, Peter.
Hello, good morning.
Let's start with the news that President Joe Biden has withdrawn from the US presidential race after weeks of mounting pressure from Democrats. He said it's in the best interests of my party and the country. He's going to stay on for the final 6 months of his term, and he endorsed his vice president, Kamala Harris, to be the new Democratic nominee. Ms. Harris says she intends to earn and win the nomination and do everything in her power to unite the nation to defeat Donald Trump. Let me get your thoughts on the market reaction to this and how investors might take this. Alex, do you want to kick off? What are your thoughts about how the markets might perceive this?
I think the market actually will stabilize a little bit, but just because of the oversold condition on Friday. The odds on Donald Trump actually is still the favorite, and I don't think the change in nominees from the Democratic Party will change a little bit, change the odds. So market will still discount a Donald Trump presidencies, but I think probably people would not be too keen on chasing those Trump trade at the moment. So I think the market actually will stabilize a little bit, and I would not be too excited on this news because I think people will still reckon Trump would be the favorite.
And what is the Trump trade? What should you be doing if you think that Donald Trump is going to win in November?
Well, in the meantime, people are buying Tesla, Bitcoin, and also stuff like banks and oil. I think we should be a little bit cautious on Trump trade because another reaction on the Trump trade actually is the weakness in the Treasury, especially on the long side. So this actually may be a little bit contrary to the market think. The bullishness for the small cap actually may not be too sustainable in the longer term.
Okay. Peter, what are your thoughts from an investment perspective? Does this change anything?
It's hard to say. We still have so many more months to go, and we've known former President Trump to be swinging with the wind very quickly. With a lot of inconsistencies in his policies and narratives. So I think it's a bit too early for us to call definitively what a Trump trade is. As far as the latest news, I mean, it's already pretty late isn't it? I mean, we can hardly call this a preemptive strike of any kind. Mm-hmm. So I think, I do think that the instability will continue as we've already seen. The markets have already rallied despite the latest correction, pricing a lot of the economic upside. So I do think that maybe unlike the consensus where they feel that the Trump winning is going to be good for the markets, I fear that perhaps a lot of that has been priced in, and that for the remainder of the next few months, we may see some unexpected volatility.
Okay. Well, I want to get back to the markets a little bit later on this morning because there is a lot going on elsewhere as well. Let's talk a little bit about the third plenum. China's top leaders, they've given security the same level of importance as economic growth. That was from the communique concluding the third plenum. It warned of geopolitical risks. It said China should lead global governance. And the leadership also backed a vision for China that pledges to balance economic developments with security and encourage market mechanisms while maintaining order as they seek to create a socialist modern power by the middle of the century, although they didn't provide any detailed definition of that. And the communique, which sets out the growth strategy for the next 5 years, in it, Beijing pledged to accommodate the private sector, although it didn't signal any reduction in the role for state-owned enterprises in the country's economy. They also talked about implementing various measures to prevent and resolve risks in key areas, such as real estate, local government debt, and small and medium-sized financial institutions. Finally, they added that China needs to weave a dense social security, risk prevention and control network and effectively maintain social stability and step up state propaganda. They said it's necessary to strengthen public opinion guidance and effectively prevent and resolve ideological risks. Alex, what are Beijing's priorities here from this, do you think, having seen the communique? I know we're going to get more details over the coming days in separate documents, but what do you think Beijing's priorities are?
I think the priorities, of course, is stability. I think that is social stability is always the top priority in China, I think. And for the economic side, I think they are more concerned on the top line rather than the bottom line. So I think this would still be bad for the stock market, but the overall economic growth may not be too bad. So people would still have a lot of business to do, but they will struggle to make huge profits. I think that is the message. And so that's why I think the whole market may not be too excited in China.
Did it address the economic challenges the country faces? We know what they are. Beijing knows what they are. They've spelt them out many times. But did it come up with any solutions?
It is very difficult because I think that the major issue is the private enterprises' confidence. I think that would need a lot of time to repair. So even though they probably will reckon that, but the solution is to boost the importance of the state-owned enterprises. So I think there's the short-term remedies, and they probably will still take that route.
So that's going to make it difficult for private firms and maybe foreign firms.
Yeah, I think it will still be very difficult. And in the stock market, actually, it would be reflected on the strength of those SOE and the weakness in those private enterprises.
Mm-hmm. Peter, what are your takeaways from that initial communique, anyway, that we saw at the end of last week?
Well, I think the Chinese government's biggest problem now cannot be resolved through elegant, even logical communique. I think maybe 5-6 years ago that was possible, but I think events over the past few years has made it so that talk is really not enough, that they have to respect the credibility and their true intent of their policies through action. And that takes time. So I think, the times where we're on our edge of our seats for that the communication from the central government that used to flow directly into policy action, those days seem so far away now.
I mean, they seem to sometimes be disagreeing with themselves, because after that communique, which made no mention whatsoever really of any stimulus, we then had the call from one of the senior Communist Party officials to provide some stimulus to boost the economy and also to try and distribute growth more evenly among the regions and the industries. So on the one hand, no mention of stimulus, but then on the other hand, you do have senior officials calling for more fiscal stimulus.
Exactly. No, I mean, so it's a lot of it is to be putting a band-aid over much bigger problems. It needs to be a concerted, centralized, and consistent policy communication and actions and follow through. And I put at least a year of that consistency and coherence in order for the market to start to take this type of a policy announcement seriously.
What do you think this means for foreign businesses who operate in China? I mean, obviously, there seems to be still a lot of resources going to the state-owned enterprises, to favoured sectors. How are foreign businesses likely to react to this, including maybe South Korean companies that operate on the mainland?
Sure. So speaking with a lot of the companies do hyper operations, I would say definitely more than half, if not majority, are continuing to work, but with a very, very firm exit plan should this political and business environment conditions continue to worsen. And I don't think that's really obviously there are companies who will continue to talk about being committed. But I think the plan B is definitely for many of these companies a very important element in their business plan. Korean companies, fortunately, they got a very early signal from that THAAD issue that occurred 2015. That they were faced with a lot of the trade and business embargoes that got a lot of the companies to wind down a lot of their exposure. So in a way, it was a bit of a blessing in disguise that they got an early warning of this very difficult business environment that China has become.
And what would it take to actually trigger companies going to execute their plan B?
I'm not sure whether there is a bigger trigger now. Obviously, the deterioration of the business sentiment, I guess these communique not being followed up will continue to signal that perhaps there's no turnaround in sight. But I'm not sure whether there is a trigger now. We've seen so many of these negative triggers already. Perhaps just a gradual turnaround, but in the face of a geopolitical risk spiking to a potential military confrontation, I think we've seen a lot of the negatives already. To be frank.
Alex, where do the markets stand in terms of China at the moment? The communique said we must better leverage the role of the market. It said it wants to foster a fairer and more dynamic market environment to make resource allocation as efficient and productive as possible. And also it said it wanted to remedy market failures. Now, before, in previous third plenums, they've talked about giving the market a decisive role in resource allocation. It seems like the role of the market has slightly been downgraded a little bit in this plenum. What are your thoughts?
No, I think the market actually is still continuing a bearish stance on China. So that's why they would reckon that as a market failure. I think that needs a lot of things and time to fix it. So I think that's why they probably would downplay the market mechanism a little bit in the meantime. I think the market actually is very concerned about the profitability of those private enterprises. They are okay with those SOE, but I don't think they would be having a very strong confidence towards the private sector. I think that is the issue that China need to address. So and also SOE actually are stable, but the management ability actually is still questionable in the long term. So I think the current development actually is not healthy, even though the market may not be super bearish. But I think the strength in the SOE would not be enough to attract a foreign interest and also restore investor confidence locally.
I mean, they talk about sort of national security and economic development being on a par, but do you get the feeling that when push comes to shove, if it's a choice between the two, it's going to be national security rather than economic development?
Of course, I think China always about stability and security. So I think that would always be the top priority. Yeah.
And anything there that makes you think that they're trying to do something to address some of the geopolitical risks, the geoeconomic risks, and the trade tensions that they have with other countries around the world?
I think that is very difficult because it's a two-side issue. So this is not just from the China side; it's also from the Western side as well. So for China, I think what they can do is just to expand into other new territories. So they probably would try to forge a better relationships with Middle East or the Latin America. I think they need to do something in expanding their businesses elsewhere, because the Western actually would, I think, maintain a tight stance.
Peter, what are your thoughts about the geopolitical risks? Any signs at all that China wants to try and address them, or is it just going to continue down the same path, which many people say is going to just lead to increasing trade tensions?
I think that depends on what Trump 2.0 looks like. If Mr. Trump, like he did during the first term, becomes confrontational with its traditional allies, then that gives China an opportunity to try to build their own front with those fractured relationships. So I think that will be not so much in the decision of Mr. Xi, but Mr. Trump. So I agree with Alex that in the meantime, they'll continue to try to forge alliances and bilateral relationships and trade with the countries that are clearly not so committed to the U.S. alliance. But if Mr. Trump, as he has done and as he has threatened, for instance, to divide up NATO on the basis of defense spending, that I would think is an unexpected boon for what China is trying to achieve.
Well, he did talk about in his acceptance speech last week at the Republican National Convention. He really doubled down on some of the nationalistic rhetoric, and he put trading partners on notice that there could be more measures coming. He said, "We've long been taken advantage of by other countries, often being considered our allies. We lose jobs and revenue. They gain everything and wipe out our business," he said. He said he stopped it 4 years ago and he's going to stop it again. And he specifically addressed the US car sector. He said he vowed to use taxes, tariffs, and incentives to help the US car sector. He said he's not going to allow massive auto manufacturing plants to be built in Mexico, China, or other countries. It sounds like, I mean, he's said it before, hasn't he? And he's done it before. Sounds like he's going to do it again.
Yeah, I would be a little cautious about Trump's consistency on that rhetoric, simply because that sounds like very much a vote-winning strategy that has worked well, and that Democratic Party has also adopted very quickly, right? Mm-hmm. I wonder, with his final term in his pocket, whether he continues that stance, because whether that is just a vote-winning strategy or it is something that he truly believes in and that he's going to implement. So that, to me, is one of the greatest uncertainties, whether that his policy is going to remain consistent during the second term.
But there was a bit of a change in one of the things he said. He did have this openness towards Chinese automakers actually building cars in the US, opening factories in the US and building cars there, which is something the Biden administration hasn't been very keen on, although, and in contrast maybe to the EU is also encouraging China as a way around this to actually build their plants in Europe. Now, he seemed to be open to that idea, but said if they didn't agree, then he was going to put taxes of 100 to 2% on each car so that they're actually unsellable. So that was a slight change, wasn't it, in tack there?
Yeah, I mean, I think it's probably a little glimpse of the not so uncertain terms in which he enters a second term. Mm-hmm. For us to believe that his policies can be clear and transparent and forecastable, I think it's to me a real risk that for the market. So I remain fairly braced for many tweaks and even pivots on some of his policy during the first term versus the second one.
Mm. Alex, what are your thoughts? How seriously should we take these threats to, in effect, double down on tariffs and other restrictions and make it almost impossible for particularly Chinese companies to sell their products into the US unless they're made in the US?
I think in the meantime, it's not necessary to take risk on those manufacturers in China. I think even without these kind of threats, I think they are still not going up. I think so. My stance is just stand aside on this sector and wait for clearer signals to emerge. I think that is the better strategy. So, but I think in the longer run, probably we would still facing higher tariffs everywhere in the world for Chinese cars.
And presumably this is going to apply not just to China, but it's also going to apply to allies as well, like Japan, South Korea, the EU.
Yeah. You can see during this Trump trade week, actually, other markets underperformed the U.S., even though U.S. has actually a huge sell-off in tech. But the sell-off in tech in Japan actually is much bigger than those in the U.S. So I think that people are a little bit concerned about the American first Trump's agenda. Yeah.
Well, we saw, as you mentioned, we saw that in the markets last week. In Asia, the two worst performing markets on Friday were Taiwan and Hong Kong. The Taiwan weighted declined 2.3% on Friday amid reports of not just what Trump was saying, but also reports of further restrictions on chip sales to China by the Biden administration. Also, the Hang Seng lost almost 4%. Almost 5% last week. It does seem, doesn't it, that markets are starting to sit up now and take notice of some of these things.
Yeah, I think for Hong Kong actually is a bear market, and it just continued the bearish trend. Without any positive catalyst, actually, Hong Kong would go down because of the concern of deflation and also the geopolitical situation. That's the natural trend for the Hong Kong market. But Taiwan is a little bit overbought earlier. And also, I think after the TSMC result announcement, people are just jump into exit. So that is also dragged down the market because TSMC is just too huge in Taiwan right now. So the impact from those sell-off actually is very big. So I think Taiwan probably will stabilize soon, but for Hong Kong, I think we will still be going down.
And Peter, what about South Korea? The Kospi down 2.2% last week, biggest weekly decline since the middle of April. Samsung Electronics down 2.9%, SK Hynix off 1.4%. Obviously hit by the same concerns as many of the other markets in Asia about restrictions on chip exports and equipment and the like.
There are two drivers that has gotten Korean stock market to outperform the region year to date. One is the tech theme related to the NVIDIA trend, and that's something that's not that different to Taiwan. But another thing is that the Korean government has been very aggressively promoting its what they call value up program, which is to very similar to the Japan version of trying to revitalize the capital markets through very transparent, proactive measures to enhance capital management and shareholder rights. And that, to me, has led to this sort of bifurcated market action, where on one hand you have the tech sector rising, which is pretty expensive already, but then on the other side, the cheap valuation sectors like certain chaebol heavy industries, as well as in particular Korean banks. So while the tech sector might go through a bit of a correction, I think the government's effort to enhance shareholder value, that I consider to be something that's more sustainable and maybe a multi-year trend. We certainly hope so here.
And are we right to put this in the sort of a similar light to what's going on in Japan, the reforms, the corporate reforms that are going on in Japan? Is it a similar sort of process that we're looking at in South Korea?
Certainly the long-term direction is similar, but there are certain differences. One is that the Japan, from its initiation of the Abenomics, they've been going for this type of reform plan for 7 years now. aggressively, whereas Korea had just started last year. So they have a long way to go. But certainly, watching the investor reaction, positive reaction to their reform efforts have really spurred on the Korean policymakers to follow the formula with certain differences. One thing that I have highlighted is that Japanese companies are very aggressively, for the first time in its history, shedding non-core assets, including cross-shareholding in unrelated companies. That we haven't seen in Korea yet. And that really has been a big driver of the Japanese stock re-rating. So maybe that's still ahead for South Korean companies.
And could it have the same impact on the South Korean market as it's had on Japan, where we've seen stocks in Japan go to record highs now on the back of these corporate reforms? Could we see the same thing in Korea?
Unlikely. I would like to think so, but another key difference with the Japanese bull market has been the depreciation of the yen, which has depreciated 40% over the past 3 years. I don't expect the Korean won to depreciate to that level, because that would actually cause a lot of systemic risks. So we'll have a milder version of the currency effect, but definitely not to the extent that we've seen from Japan.
Alex, let's talk a bit about the Hong Kong market. Last week when we spoke, you were bearish about Hong Kong stocks. Maybe were you bearish enough? Because it's been quite a bad week, hasn't it, for Hong Kong?
Yeah, I wish I'm more bearish. I was more bearish last week, but I think for the Alex index, I think it will stabilize soon. I think even though last week I said it has topped, because the bond market actually in China probably will stabilize and will not surge further. So that's why I would say there would be a top in the Alex index. But I think the volatility elsewhere in the world actually would make those high yield in Hong Kong a little bit more attractive now. So I would say the Alex index actually will stabilize soon. But for the overall Hang Seng index, I think we are still bearish. People are still very concerned about the deflationary pressure in the China consumer markets, and also the geopolitical situation will still be bad, and also the manufacturing sector actually would go along down with those peers in the world. So I think the overall trend in Hong Kong actually is still bearish, and also the treasury market in the US actually is weaker than expected. So those public stocks in Hong Kong actually would not go further up after last week rebound. So I think the overall trend is still bearish, but I would a little bit optimistic towards the performance of my index.
And just to remind listeners, or listeners who may not have come across the Alex Index before, this is an index of 5 stocks that we created back in September last year. It was basically 5 stocks you thought were going to outperform in what was an up-and-coming bear market, which proved to be correct. The 5 stocks: HSBC, China Mobile, CNOOC, China Resources Power, and Zijing Mining. Well, the performance so far since inception last September, your index is up 26.5%. The Hang Seng index is down 2% over the same period. So a good positive outperformance. Although I should point out that at its peak a couple of weeks ago, it was up almost 40%, the Alex index.
Yeah, because we are seeing some profit taking. And also, as I've said, I think the bond market in China actually have stopped the rally. So this will make those high yield a little bit less attractive. I think the profit taking actually is more or less done. So and also I think it will stabilize. And if you are not in the index, I think this is a good time to pick up some. I think in the meantime, yeah.
And one of the stocks in your index in the news, HSBC, they've found a new CEO to replace Noel Quinn, Jules El-Hedry, who's the current chief financial officer. What difference does that make to HSBC?
I think not much. I think people. My bullish is on HSBC actually. It's building on its asset management business prospect. I think they will not change too much on this personal change.
Okay. Peter, let me get your thoughts on the US markets. The big theme really last week, wasn't it, was this switch out of the year's big mega cap winners in favour of smaller names, in particular some of the small caps in the Russell 2000. And then we saw the big mega caps like Nvidia, Apple, Meta, Microsoft take a fair big hit. Do you think this is sustainable? Is this is this trend now going to continue?
Oh, that's the question on everyone's mind. I think even a few months ago, I would have said that NVIDIA would continue to outperform simply because it has real earnings and growth expectations of transitional technology rarely finishes after 12 months. So that is sustainable. But in the short to medium term, the fervor and the flow of funds into that small number of stocks has been so intense. You'd have to think that this type of correction has to come. I think the question is this a healthy correction or much more sustainable performance, or is it something that the market has to now rebalance the bifurcation of the markets that we've witnessed for almost 12 months now? We see bifurcation everywhere nowadays. It's DM versus EM, Europe versus US, tech versus old economy, small versus large caps. I mean, the divergence of these baskets are so wide. You'd have to think that a mean reversion will have to come through. So we're seeing one now. I would say that it's definitely healthy, simply because if we didn't have one, we may have a bubble that may get out of control some point in the near future. So I do consider it to be healthy, but how sustainable it is, I think really the Fed, whether they yield to the market pressure for a rate cut. I personally have been, for most of this year, on the hawkish side, that we may not see a rate cut so soon and so readily. I think Alex mentioned about the outlook for tariffs being sustained for longer, which has to feed through inflation. So what the market wants to see is not necessarily what we will get. But of course, again, Mr. Trump comes in and he'll just unleash all policy levers to see the markets grow, and because he really wants to take credit for the growing wealth of all Americans, doesn't he? At the expense of everything else. So I would say the healthy correction from now till the election, but I think if and when he comes into power, I would have to say that we have to look at the further upside in market, at least in the short term.
Alex, what are your thoughts? I mean, these small caps, they do have value on their side, don't they? But then the big mega tech companies, they have earnings on their side. They've got earnings growth, real earnings growth, and momentum, earnings momentum.
Yeah, actually, I would be on the tech side in the long term, as Peter suggests. In the short term, even I don't think this rotation will last long. But if you look at the bond market reaction, I think it suggests that people are not too bullish on the magnitude of the rate cuts in the long term. So I think the revaluation in the small cap actually would be limited. And also the pullback in this small cap actually is quite fast during the later part of last week. So I will not be too bullish on the small cap side. If you want to buy, I think S&P probably would be the better choices. This is a little bit in the middle, but I think that would still be better than picking the Russell 2000 right now.
Okay, well, thank you both very much. Have a great week. You heard there Alex Wong, who's director of Alex KY Wong Asset Management, and Peter Kim, head of global investment strategy at the KB Financial Group in Seoul.
Peter Lewis's Money Talk.
I'm joined now by Yanan Wu, who is the chairman and CEO of Surfin Group, headquartered in Singapore. Morning, Yanan.
Good morning, Peter. How are you this morning?
I'm very well, thank you. Let me ask you about the third plenum. We received the communique at the end of the third plenum last Thursday. What do you think China's priorities are now in terms of going forward and in terms of trying to stimulate economic growth?
Yes, the third plenary yearly is a very important one, especially, after every new government, new leadership. Normally, they put the agenda of the new government policy in the third plenary meeting. This is, of course, already the new term for Mr. President Xi and his government, the new government. So that's why globally, every market force participant and also the government, looking what's the new message for the new third plenary meeting. In the past, the third plenary meeting back in 1978 was reinforced China's the new economic reform, the new policy regarding the agriculture, and in 1984 is about socialist market economy. In 1988 and 1993 is all about policy reform and socialist market economy reform. So I think in the past, the importance of third plenary meeting can give the world a new direction for this new government initiatives. Of course, for this one, the current one, it has been delayed almost 1 year. So that's why it's even more anxious for the market to understand what's the new direction for the new leadership and the new government team. So if you look at the one keyword for this third plenary meeting, that's reform. So reform. It's for the next 5, even 10 years, the new reform roadmap. Because in this communique, we can see by the 2029, the 80 years anniversary of PRC, all the reform agenda has to be complete. So that gives a very clear roadmap and the key timeline for the reform. So what about the reform? I think there are 3 parts. One is about the so-called new uniform market reform. So the nation want to build a one uniform market. So that's including land, data and technology. So to let the market force play a vital role in the future government policy direction. So that's the first part. Second is about the redistribution of so-called revenue between the central government and local government. Because how to increase the revenue for the local government is also very urgent demand from the policy makers. So how to redistribute, such as consumption tax, VAT, between the central government and local government can help the local government gain more revenue after the so-called property market has been reformed in the new high quality economic development era. The third one is about technology. The technology, of course, the new quality, productive force. For the new AI, new renewable energy, and the new trails for the market force is how to improve the technology, the role through education, investments through the technology instrument, and also boost the private enterprise role in the new quality productive force, such as AI and also the new renewable energy, the green energy sectors. So those are the three key reform agenda. According to the communique, the openness is the characteristic of so-called Chinese modernization. So that's a general message for, I think, for this third plenary meeting so far.
And what about the role of private companies in these reforms and going forward? There has been some concern that they are struggling to get resources compared to some of the state-owned enterprises where the government tends to put priorities. We've seen in the fixed asset investment numbers, investment by private companies just 0.1%, much lower than the 7 to 8% growth in investment we're seeing by state-owned enterprises, which tends to suggest they're lacking confidence at the moment in the economy. So what role do private companies play?
Yes, the private enterprise and the so-called the market force is very vital, I think, for the new reform roadmap, and that's also what the globally want to look at. From the new direction, a new roadmap, what kind of government message for private enterprise. But so far, I think in the communique, we can see the third plenary meeting want to avoid so-called market failure in the reform when it's balancing the SOE or government policy versus between private enterprise and the government background, the enterprises. So I think this is continue. I think for the next reform agenda, how to increase the confidence of private enterprise and how to boost up the private enterprise weight in the economy, as you just mentioned. But it's also interesting when you compare the 18th Congress third plenary meeting, that was 2013, about 10 years ago, a decade ago, versus 20th Congress third plenary meeting, that's the current one. There's two keywords that shows increasing much further, more than the previous one from the current one. One is the security. In 18th Congress plenary meeting, security was mentioned 6 times, but this time mentioned about 16 times. And the other one, of course, is about education and risk, also mentioned more frequently than this time. So I think security is also one of the new message compared to the last one. So that's why I think the government enterprise was trying to boost up the scalable economy when the globally it's more rather than pro-globalization, but more like a reverse globalization and globally. So how to maintain this security for Chinese economy. So that's what the government concerned. So I think the government role still plays a very important one in boost up the scalable economy and increase the security.
Where does national security, where does security stand in relation to economic growth? Are they on an equal playing field now, or do you think security is going to trump economic growth? Where do you think they stand, the two?
Yeah. I think it's a very tricky balance, and especially when you consider this new election from the U.S. President Trump may be most likely win the second term. So I think we'll have to see that the security is more like a global keyword and the phenomenon. So for China, I think there's a lot of key technologies still held back by the U.S. sanctions and also the Western decoupling. So I think the de-risk and the decoupling still China want to balance when it considers some key technology, key sectors still, maintained very high focus from the government point of view. So national security in terms of AI, in terms of data, in terms of all the important technology that will help China achieve the Chinese so-called modernization. So it's really, I think that's in terms of how to maintain the national security. So I think private enterprise has to find a room within such a framework to contribute or to improve its function in increase to fit in this such a national security balance. Yeah.
And what is China's plan to deal with some of the geopolitical tensions, or to try and reduce even maybe some of those tensions? Because we heard Donald Trump last week talking about more tariffs, more restrictions on the export of Chinese goods to America. He was talking about tariffs of 100 to 200% unless China builds electric vehicles in America. We've also had the Biden administration talking about more restrictions on foreign firms if they contain American technology, particularly companies like Tokyo Electron, ASML, who manufacture the chip equipment that's needed to build chips. What is China's plan to try and deal with that and cope with that?
Yeah, I think that's also will play out, after November, when I guess the new U.S. government will have probably welcome the President Trump back to the White House. So at least for now, we can see if ever President Trump is 2.0, in the next 4 years. So I think the more sanctions and the more higher tariff are definitely on the agenda, like you just mentioned. But on the other hand, I think the Trump 2.0 may learn from the first version. So it's 1.0 version, so which means it probably more flexible in terms of negotiating and trades, because Trump definitely will win more majority within the Republican domestically. So it has more room for its own playing out the trading and also negotiating tactics. But for China's perspective, if you can see, before the third plenary meeting in June, President Xi went to the National Science Technology Congress and gave lots of important awards. And in Dalian Davos Forum, Premier Li Qiang also talking about the science and technology reform and revolution. So I think China definitely want to maintain some key technologies such as chip and semiconductor within the its own strong capability. So we'll see a lot of investment from industrial policy from the government level to support this new AI technology era. But on the other hand, there's more, I think, higher tariff will cause, pricing volatility in this sector as well. So I think if you use one word to summarize Trump 2.0 globally, probably more volatility, rather than consistent policy. So it'll be back and forth negotiation and the trading tactics from China, US, these two governments.
Yanan, thank you very much indeed for joining me this morning. Always a pleasure to discuss these things with you.
Thank you, Peter.
That's Yanan Wu, who is the chairman and CEO of Surfin Group, headquartered in Singapore.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. And I'll be back with another show tomorrow. Joining me then will be Mark Michelson, chairman of the Asia CEO Forum at IMA Asia, David Roche, president and global strategist at Independent Strategy, and from Texas, USA, Tony Nash, the founder of Complete Intelligence. See you tomorrow. tomorrow.
Money Talk